So here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. This episode of Value Investing in Your Car, I'm going to tell you what you should and should not do with market valuations at or near all-time highs and, frankly, insane in some cases, which I'll illustrate in a second. Before I get to that, though, I'll let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You get this as part of the Value Investing in Your Car podcast and listen anywhere in the world for free. Okay, so valuations are a little crazy. I've been saying this for a long time. Today I want to illustrate to you how crazy the valuations are, though, and then I'll tell you what you should and shouldn't do. Okay, so I'm going to show you three different metrics today. This is Warren Buffett's favorite overvaluation or valuation metric for the kind of entire market. This is total market cap compared to GDP. And here is, in this chart here, this shows you the kind of ranges. Right now, after the latest GDP came out, we are in the significantly overvalued range. Over here, it shows you what returns you should expect based on the valuation. I'll tour on this page as well. Frankly, the math here is a little over my head, but I'll explain what this means kind of in a real world sense in a little bit. So that's one metric. This one, is S&P 500 ratio. This last week, hit an all-time high, even higher than the during the dot-com boom. And I don't have the chart up. This isn't the right chart, so I apologize for that. But last week, this hit a all-time high, again, even higher than the dot-com boom in terms of valuation. And then over here is the Shiller PE ratio. This is one of my favorites. I like using this to kind of get a gauge of where the market's at in terms of valuation, because this strips out inflation and it shows in historically, again, going back to the 1800s. So it shows you the entire history of the market. As of right now, we're over here at about 31.5 rounded up. The only times in history that the U.S. markets have been as overvalued as they are now were right before the Great Depression, the dot-com boom, and earlier this year in March before the crash. Before the coronavirus pandemic crash, whatever it's going to end up being called years from now. So hopefully, again, I've been saying this for years now, that valuations are absurd on individual stocks and absurd market-wide. Hopefully this illustrates to you that's the case on pretty much every single metric that you look at. The valuations for the entire market and also individual stocks is absurd. It's absurdly high. What does this mean, though? So when most people talk about valuations and being overvalued or undervalued, they don't kind of explain the context. So what is something when it's overvalued, like, again, most individual stocks are and the entire market is right now? What does that mean? It means going forward that there's an enormous amount of risk in the market. Or let me back up. There's a lower margin of safety in the market and investing there, which makes investing in the market or assets that are involved in the market, like stocks, enormously risky or more risky. And this also means you should expect to earn, if you, let's say, buy an index fund today, you should expect to earn lower returns going forward because the valuations are so high. The inverse of this is also true, which is what we as value investors try to do. We try to buy undervalued assets. So undervalued assets do the exact opposite of these. There's more margin of safety. There's less risk. You should expect to own or earn higher returns going forward on stocks or the market or whatever you're buying. So this is why valuation is important. And this is because we're in the extreme, in some cases, overvaluation range, that means based on the kind of definition that there's extreme risk in the markets right now. Is there extreme risk in the markets right now? I would say so. But again, I've been saying this for 5, 6, 7, 8 years now. Because of the massive Federal Reserve manipulation that began 2006, 2007, 2008 timeframe. It hasn't really stopped. There's an enormous amount of cash being pumped into the system. This cash pushes interest rates down, or one side effect of that is that they're also pushing interest rates down. So companies that are getting this cash and banks and institutions, big corporations that have this kind of cash, they're looking to invest it. So can't invest in bonds because bond rates are pretty much nothing right now. Savings accounts are pretty much nothing right now. So after taxes, after inflation, they'd be losing money if they invested in those. Most entities, public or private, don't know how to invest well in real estate, so they won't invest there. And some companies can't invest in real estate. So that leaves the stock market as the only place to invest. This is bad. This is bad. Again, this has been going on for 10, 12 years now. Actually, more than that. About 14 years now, depending on the time frame. It's really bad. This is why you're seeing historic debt levels at all-time highs for governments, for corporations, for student loan debt, for auto loans, for home loans, because people are looking, they have cash, but they're looking, especially with the Federal Reserve and Federal Reserves worldwide, frankly, printing an enormous amount of money and lowering interest rates to pretty much zero or negative in some cases. They have cash, but they're looking to invest well. Frankly, where else to put it other than the stock market? That's the only place you're going to earn even somewhat of a decent return right now because of the manipulation that's been going on. Is this good or bad? Frankly, it's going to end up bad because at some point the bubble is going to burst. Again, it could be, I just told one of my colleagues this last week. It could be tomorrow. It could be 10 years from now. I have no idea when it's going to burst. But when it does, it's going to be bad. Why is it going to be bad? Especially if it happens sometime soon with the coronavirus pandemic. There's tens of millions unemployed in the U.S., hundreds of millions worldwide that are unemployed. This will put even more people on unemployment. With the economy, the economic issues, looks like we're recovering a little bit, but depending on which numbers you look at, there's no essentially margin of safety if we are a crash now. Another reason there's no margin of safety is because the Federal Reserve can't keep lowering interest rates to negative numbers. They can, but it'll be useless. So what they're doing by pumping all this money into the system, lowering their interest rate so low, is they're trying to save the market, I guess. But again, it's going to end up badly because it's going to build a bigger and bigger bubble, which is why we're seeing valuations at or near all-time highs. Again, we're talking about Great Depression. We're talking about tech bubble. We're at higher valuations now than we were in 2007, 2008 crisis. We're at valuations we haven't seen since the early 2000s, tech bubble earlier this year, and the Great Depression. People don't think valuations matter. They matter an enormous amount, again, for all of the things on top of the normal things that, of course, margin of safety, risk, high returns. But that's all the things I just mentioned before this. They're important because they will directly affect that when the bubble bursts. Again, I don't know what it will be. There's some kind of beautiful deleveraging, like Ray Dalio says. I hope there's some kind of soft landing, as other people call it, whatever you want to call it. I hope there is. And I had this conversation on Facebook the other day when I posted that valuations are at all-time highs with another value investor. He said, I don't think that kind of stuff you're talking about is going to happen. I said, I hope it doesn't happen. I hope it doesn't happen. It's going to be horrific if it does. For the economy, for individuals, for companies, it's going to be really bad. But I've studied an enormous amount of financial history, enormous amount of world history. I don't know how to get out of this situation because essentially what we're doing over the last 12, 14 years is there's been so much manipulation that we're just building more and more and more and more debt. And I'm not even talking about the U.S. national debt, which is atrocious by itself. I'm talking about, again, corporate debt, individual government debt worldwide, car debt, home debt, student loan debt, all that kind of stuff. Pretty much at or near all-time highs you can't just keep adding on more and more debt. It doesn't work. It's all being funded by the Federal Reserve's manipulation because they're making it pretty much impossible to invest in things like bonds and other assets. So people are going to the stock market, which it keeps increasing the valuation of the stock market higher and higher. Over the last couple of months, as we've been locked at home, you've seen even more rampant speculation because people are stuck at home. They're bored. They're trying to figure out some way to make money. So they're trading and valuations go even higher and higher and higher. It's going to end badly. The reason I've been doing so many videos on kind of macroeconomic stuff lately, which I normally don't talk about at all, is because I want people to understand how this all kind of plays a part in things together. Valuation, the economic issues in various industries worldwide, economic issues, the bankruptcies, the banks, all this kind of play together. Because if you understand all this stuff, then you can sort of, again, if you're in a decent position, understand how to protect yourself, which is through being rational, which is through value investing processes, which is being patient and disciplined and learning. That's why I teach the stuff I teach as well, is to protect people from this kind of stuff, because I don't, and I'm nervously laughing, but over the last probably 2 months, I've been approached by dozens of traders or people who want to trade and want my opinion about trading and investing. You always hear about traders off and on, but until the last few months, it wasn't everywhere. And I've seen it literally everywhere: emails, Facebook, YouTube, blog posts, individuals that I know personally talking about trading. It's scary how many people are trading right now when they don't know what they're doing, and it's with valuations at or near all-time highs. It's going to be horrific for these people. And that's why, again, I'm trying to make these videos and get them out to as many people as possible to hopefully protect some people. I know it's unrealistic to protect everyone, because people are going to do what they're going to do anyways. But the more I can talk about this stuff, the more people can see it. Hopefully some people will get out of the market, or not even get out of the market entirely, stop trading and learn a disciplined way of doing things other than kind of in and out, in and out, in and out based on emotions. Because over time, that doesn't work. It can for a while. You can make money off of it. You can make huge profits off of it. But over time, it doesn't work as well as long-term investing, because of the transaction cost, because taxes are higher on short-term trades, because the more trades you make, the higher likelihood you have of making mistakes, all those things. And again, the Federal Reserve is manipulating everything, and people are trying to figure out ways to make money, and there's nowhere else really to put it. It's been going on for 10, 12, 14 years, and it's continuing to this day. I said years ago, when the Federal Reserve kept printing that money during the Great Recession, when I was still kind of in the infancy of my value investing journey then, but I told people that I was close to that essentially what they're doing is kicking the can down the road. All this easy money, all this cheap money, leading people and companies to take on more debt. And that's what we're seeing today. And again, I don't know when it's going to end. I don't know how or when it's going to end, but it's not likely to end well, unfortunately. But this all comes back to valuations as well. So the manipulation keeps increasing the valuations higher and higher, which is essentially building a bigger and bigger bubble. Frankly, I don't know what the Federal Reserve can or even should do at this point, because if you take the free money out, the economy goes to shit. More people lose their jobs. More bankruptcies happen. The economy seizes up. But if you continue adding more and more debt, then the party can keep going for a while, and you can hope that the party will keep going and there'll be, again, some kind of soft landing. The Federal Reserve, again, U.S. and worldwide, have essentially built them into with a proverbial rock in a hard place. Again, I don't know what better option there is at this point, other than I honestly can't think of a better option. I just can't. And again, I'm an optimist. Like I told this guy, I was this other valuist, I was having a conversation with the other day on Facebook. I'm an optimist, but I'm also a realist. And I can't think of another better option for the Federal Reserve to deflate this bubble. Because again, if you pull the money out now with the economy and the amount of people that are unemployed now, the stock market will crash. So I don't know what they should do or shouldn't do. Frankly, they should stop manipulating the market so much in the meantime while we're not dealing with this crap. So we can better deal with situations, so there's not as much debt, so there's not as much manipulation, so there's not as much malinvestment, essentially government sanctioned malinvestment. They should stop manipulating the market, is essentially what it comes down to. But again, that's not going to happen. So I don't know what the other options are. If you have other options, let me know in the comments below, because I can't think of any. But I hope this helped. I hope this kind of illustrated the power of valuations, and not only does it affect the kind of normal things that people think about, but it also affects these other things as well. And also we talked about why these these super high valuations are happening as well, potential causes and effects of them, what the Federal Reserve should and shouldn't do, all that kind of stuff. We covered a lot in this video. So if you have any comments, questions, concerns, let me know in the comments below. If you're listening on YouTube or watching on YouTube, sorry, make sure to like, love, share, subscribe, and hit the subscribe and hit the notification bell so you're notified every time we release a new video, and they're releasing new videos all the time. If you're listening on the podcast, again, like, love, share, subscribe, all that good stuff, and comment. and really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking to protect yourself in this kind of situation, check out the links below this video. There will be links to free resources. I got my 7 tips guide down there to picking great stocks 3 times. In that guide, there's also 3 times that you must sell a stock after you bought. There's 5 free gifts down there. There's my free PDF book of how to value invest. There's also information about our masterclass down there below as well. So check out those links. And until next time, have a great day. Talk soon. Bye.